23andMe on the verge of getting delisted now from the NASDAQ.
Drama has been unfolding this week. It's only set to ramp up.
23andMe built a multi-billion-dollar brand off of collecting people's spit. The idea was that people could take control of their health by learning about their genetics. And it took off. But just 2 years after going public, the company went from being valued at $6 billion to trading below $1. Now, 23andMe is rapidly approaching a November deadline to propose an action plan or be delisted from the NASDAQ. So how did one of the most disruptive startups of the 2000s go from Silicon Valley stardom to a penny stock? And can its CEO save the company from collapse? .23andMe was founded in 2006 by Ann Wojcicki, Linda Avey, and Paul Kuzenza.
The mission of the company was pretty straightforward. They set out to give consumers an easy and inexpensive way to access their genetic information. So they did this by developing a DNA test that you can really kind of take from anywhere.
It's an online test. You go online, you order it, we send you a little tube, you spit in the tube, you send it back to us, we extract the DNA out of that, and then we look at 1 million data points in your DNA, and from that we can tell you a ton of information about your health and also about your ancestry.
Today, this isn't all that different from competitors like Ancestry and Family Tree DNA, but 23andMe was one of the first to bring genetics testing directly to consumers at an affordable price. By 2012, the company was able to lower the cost of its kit from $999 to $299. This was thanks to capital from high-profile backers. One of them was Wojcicki's then-partner, Google co-founder Sergey Brin.
Anne is a really connected person in Silicon Valley, and she understood how to leverage star power in a way that would also help to build 23andMe's brand. So in 2008, for instance, the company famously held what they called a spit party. So during New York Fashion Week, a bunch of celebrities and high-profile guests came and gave a saliva sample, generated a ton of buzz and attention around the company.
Sales started booming. The company announced it had genotyping.
Yeah, I think if you have one of the founders of Google on your side, I'm sure a lot of companies could probably kick off and start off quite well. So that could be a start of why they're having financial struggles, is that this is a common trend that also happened in the 2000s, especially considering how cheap interest was and how easy it was to get loans and funding, especially when markets were doing well, is that a lot of businesses end up in a scenario where they end up taking on a lot of investment or debt of some sort, and they then start to run the business. And a lot of companies popularized this, like Facebook or Uber, and I'm sure a bunch more, that do this exact thing. They raise millions of dollars, they lose money year after year after year, and they start trying to build the product. And they do this in order to try to build a product quickly. So that way they can out-compete other folks into entering that market. Then the hope is that eventually they'll find the product market fit and find the right price point or the right way of selling their product such that they can eventually get to profitability. And this is a classic thing that has especially happened in Silicon Valley, where so many startups do this. They raise lots and lots of money, and then they don't actually have a solid business underneath them, but it's all under the hope that a business will be formed with these particular founders or this particular product. And this can lead to a false sense of achievement, especially early on, because then you have lots of money to spend on ads, fancy buildings, all that type of stuff. And you didn't actually put in the work to necessarily earn it the standard way of starting from the bottom, kind of working your way towards it. And so it can give you a false sense of accomplishment. And also it's a different style of management than trying to aim for pure profitability early on and then grow organically from your sales. And it makes it very hard when you do this to figure out what's the right size of company, what's the right investments to have, because if you grow your company too quickly, then you're spending money very quickly, and the timing of when you pivot and how you make certain decisions is really important. Whereas if you start smaller and wait for profitability, then obviously it's going to cost you less. A company of 2, 3, 4, 5 people is going to cost less than a company of hundreds of people. And so you have a little bit more time to kind of adjust and make small adjustments. Whereas in these big companies, you often have to make large adjustments very quickly to kind of pivot and not waste too much of the funding that you have in order to find the right fit for your business.
Typed 1 million customers. And in 2015, the company gained FDA approval to provide more in-depth health information to customers. And in 2016, it finally lowered the price of its kits to $99.
I think that every technology, it takes a while for adoption. Now it's suddenly become relatively normal. People share their stories online.
Celebrity endorsements kept pouring in, and the company was named one of CNBC's top disruptors of 2018.
And thanks so much for joining us here today. Congrats on your spot on the list, in the top 10, no less.
And during this period, 23andMe was quietly building a massive database of genetic information.
You may wonder what happens to all that genetic data that people send into the company. Well, the Silicon Valley giant now has the world's largest database for genetic research. 4 million customers have given them permission to use their DNA to study genetic diseases.
The company partnered with several pharmaceutical companies and universities to study genetic links in diseases like depression. But customers began to raise concerns around privacy. In 2018, a serial killer cold case was solved using DNA from 23andMe. The company had also started to face problems with recurring revenue.
There hasn't been a sustainable business model. It's the kind of test that you take once.
Sales.
That's pretty problematic. I would say I actually had not heard of that case, but I have never actually taken one of these specifically for that reason, which is if you hand something that is so personally identifiable, like your DNA, to a third-party company who is a for-profit company, like they're going to do whatever is in their best interest to make as much money as possible, you just have no idea what they're going to do what's with that data. Like, who are they going to share that with? And so you would hope that they have a lot of privacy, but that's actually disappointing to see that they've already kind of like handed it over to folks. Obviously, presumably that person was actually a criminal, but that's potentially highlighting a positive case. Who knows how many times they shared information where it was unnecessary or the person wasn't actually a criminal in that case. And so that's where sharing things that are so private like this certainly lead me to be cautious, to just hand over something like that to a company who you are basically signing away your rights for them to do whatever they want with it. And that always makes me question those types of products myself.
Sales of 23andMe's test kits declined 46% in 2019 compared to a year earlier. The company laid off 100 employees in an effort to cut costs. But Wojcicki still hoped to move the company beyond selling DNA tests.
And so now we're really at a point in time where I'm ready to, explode. Like, there's huge opportunities on therapeutics and huge opportunities for our consumer business.
So 23andMe wanted to leverage this genetic database that it had accumulated because, millions of people are taking this test. They have a lot of valuable data. But the fact of the matter is that therapeutics, drug development, drug discovery, it's just really hard.
And extremely expensive. One recent study estimates that drug development in the US can range anywhere from $314 million to $4.46 billion. And
yeah, so just wanted to pause there. So having somewhat been involved in the healthcare space, my expectation has generally been, if you're trying to like develop new drugs, it's like you're talking $1 billion in many cases. And so this is where that's a very expensive endeavor. And also, not every drug that folks look into and do research and development on makes it to the market because there's a lot of hurdles. You actually have to try to develop it and then succeed at developing the drug that you had in mind and it potentially being useful. Then you actually have to get it approved by the FDA to enter into trials of some sort. And then you actually have to prove that like it's more effective than a placebo, which is actually kind of hard, surprisingly. And then you have to continue to do tests, and then you have to start to market it again once you've gone through all those tests. And so it can take billions of dollars to develop a new drug, and you also might fail like very close to the finish line there. Like For instance, you could go all the way into a trial and be towards the end of the phase and then just find out like it's inconclusive on whether or not it's better or not than a placebo, and then that's it, you're done. You've spent maybe $1 billion, $2 billion on that drug and it's not going to go anywhere. And so you start over. And so this is definitely not a cheap endeavor to start working on. You likely need to have tens of billions of dollars to say with any certainty that you could make a new drug. And this definitely seems to be like a risky factor overall. And it's unclear how this as a business decided to transition. So likely the reason that they dropped their prices is one, they want to get more customers. So again, they highlighted they kind of went from like 1,000 in 2012 to basically $100 in like 2016. And this was to increase adoption and how many data points they have and how many customers they had. So there's a good chance that maybe in 2016, they started thinking about what are they going to do with this data? And they saw their product as the data itself and not the test kit or the insights. And this is where that's a pretty risky move unless you have a plan for it. So like some advertisement companies or like a Google, for instance, they collect personal information and then they sell it to other people. And that's potentially what they were thinking about doing at that time. And that's where maybe that didn't pan out as they had thought. Maybe people weren't trying to purchase DNA data as much as they had planned, and then they start to be shifting here. And this is kind of what I mean on that earlier point of you need to make these bigger shifts much more drastically when you have all this money and you're spending all this money quickly, because if you're spending hundreds of millions of dollars a year on a lot of employees that you're trying to work quickly through problems on, the difference between like a year or 2 years working on a product could be big. Like you could potentially save yourself tens or hundreds of millions of dollars if you saw what was ahead of you and shifted early enough. And so this usually leads to large swings in the hope that you're going to make it big, but also can lead to miss after miss after miss and then put your business at risk.
It can take years to reach patients. Wojcicki's solution was to take a bet on the public market.
23andMe going public today through merger with Richard Branson's SPAC, VG Acquisition Corp.
In 2021, 23andMe went public on the NASDAQ and was valued around $3.5 billion. At the time, there was a boom in SPACs, or special purpose acquisition companies.
When 23andMe went public in 2021, the coronavirus pandemic is in full swing and the market is booming. So healthcare companies, tech companies, they're raising money really, really quickly at really high valuations. A lot of founders who I talk to at this time like to joke that it's like money is free during this period.
Going public helped fuel research and development efforts despite falling sales.
I have this incredible drug discovery team and platform. I have over 40 programs underway, and I want to scale all of it. So I imagine us in the future, 10 years from now, a very robust consumer business and a very robust therapeutic side.
So we absolutely aspire to be a full-fledged therapeutic development company that is going to bring those programs to our customers.
But by 2022, interest rates had begun to rise, and the company was struggling to raise enough money to fund its research and development. The company ended the fiscal 2023 year at a $312 million loss.
All of those ambitions were there. She was trying to create some recurring revenue by a subscription model where users could tap into the more data that they got. And that data is really powerful, but there was always this problem. She couldn't really sell it. And it turns out, surprise, surprise, that healthcare, that drug development is really hard to do.
In September of 2023, the share price slid below $1, and the company received a deficiency letter from the NASDAQ. Then the privacy concerns returned.
Genetic testing company 23andMe says hackers accessed the data of nearly 7 million people during an attack in October. That total far more than previously acknowledged, accessing user data, including genetic profiles.
By 2020,
yeah, that's definitely another downside. So earlier I also talked about privacy and like trusting this entity to not be a bad actor themselves, but also you have to trust that they are putting enough safety measures to protect their data from other people. And it sounds like they didn't in this case. Obviously they got hacked. They lost some of that information. So again, that's a lot of responsibility that you're expecting other people to do with your information. And this isn't just true for like your DNA. This could also include information you're handing out to any product or any company that you work with. You always have to be mindful of like every time you share something that's very personally identifiable, like your DNA or your social security number, or even something more simple like credit card information or address or anything like that. You also have to be mindful of the fact that you're handing it to this person and thinking through what is going to happen with that data. Is this a trustworthy individual or corporation for you to share that information with? Because they not only have to be responsible themselves with that data, but they also have to be responsible enough to prevent others from getting it.
24, the company announced it was shuttering its drug development team and instead focusing on money-making obesity drugs via telehealth. Its most recent earnings report shows a net loss of $667 million. In March, 23andMe established a special committee of independent directors to help Wojcicki figure out a path forward for the company to boost its share price.
And it's important to note here that Anne is on the board of 23andMe, but she was not involved with this special committee. In April, Anne signals to the special committee that she's going to submit a proposal to try to take the company private. Unfortunately for her, the very next day, the special committee rejects this proposal.
The committee gave Wojcicki until September to offer a revised proposal, but they never received one.
Wojcicki wants to take back control of her company 3 years after going public by a SPAC, and she's rejecting outside consultants. Now she's abandoned by her board.
By mid-September, all 7 board members resigned, citing frustration with Wojcicki's strategic differences and concentrated voting power. Then, the company received yet another warning letter from the NASDAQ, saying that Wojcicki needs to come up with an action plan before November 4th.
It certainly is a big question mark as to exactly what will happen next, but a lot of it...
Yeah, so one of the big things that's happening here is the fact that basically when you're a public company, there is regulation that's in place that basically ensures that you're doing proper things financially. And there's a lot more moderation and oversight of companies in this position. So they didn't share exactly why she was choosing to take it public, but it does sound like it's very reactive to basically what had just happened, which is they're giving her warnings for what she's doing around her business. And so her game plan at this point is basically like, let me just hide everything that my company is doing. And then therefore the only person who needs to see what's happening with it is me, which is what would happen in a private space. So it's very rare for companies to go from public to private. And I think it's even rarer for them to then succeed going forward. I'm not thinking of a company off the top of my head. I'm sure that they exist. Feel free to comment if you know of one. I'd be happy to look into it. But this is definitely a suspicious behavior that this individual is doing.
Feels really up to Anne at this point. She, in a memo to employees in September, said she's going to immediately start looking for new independent directors to join the board.
Wojcicki has said in a memo to the SEC that she intends to take the company private and is not interested in third-party bids. In October, the company also announced a reverse stock split in an effort to boost its share price. As for what will happen to the customer genetic data if the company is sold, CNBC reached out to 23andMe for comment, and a spokesperson emailed back saying that the company remains committed to going private and that it will not share customer data with third parties without their consent.
Well, thank you for watching. Hopefully you enjoyed what you saw. If so, please hit like or subscribe. I will see you around.